Hello and welcome to this course titled Introduction to Banking and Financial Markets. What we will discuss in this very short video is what is banking, what are financial markets, and what are the interrelationships between banking and financial markets. If you look carefully at your own experience with your money, you will find that at some points you're a saver and therefore you're an investor. And at some other points, you're a borrower. For example, you put your money away in a bank or in a mutual fund or in the equity shares of a company. You are a saver who's investing. On the other hand, you take a mortgage loan, you take a motor car loan, you become a borrower. Exactly the same way, companies borrow and companies also invest their surplus cash. Governments, most governments in the world are the biggest borrowers in the country. And as and when they have surplus cash, they would invest it in the financial system. So whether you're a government, whether you're a company, or whether you're an individual, you are both a saver and therefore an investor and a borrower almost at the same time. Now, where do you go to save, invest, and borrow? Financial intermediaries bring the savers and the borrowers together. If you go back to 40, 50, 60 years ago, the only place that savers could go to invest their money was in a bank. And the only place that borrowers could go to borrow was a bank. Therefore, banks are the biggest financial intermediaries even to this day. Now, what is the role of a financial intermediary? It is, as you can see in the bottom part of that slide, to intermediate funds between savers and borrowers in the risk-free manner. So no matter how much money you have, you can take it and put it in a bank, and no matter how much money you want to borrow, the bank will be able to lend to you. They do what we call denomination intermediation. That means taking money from savers in all forms, small, big, large, and lend it to borrowers in amounts that they would need. Risk-free manner is an operating word. Financial intermediaries almost absorb all of the risk that goes with financial intermediation. For example, if you go and put your money in a bank and they lend it to Mr. X and the Mr. X goes insolvent, it is still binding on the intermediary to make sure that your money goes back to you when it is due to you. So they absorb all of the risk, and that's what we mean by the intermediate funds in a risk-free manner. Examples of financial intermediaries: banks, they are the biggest financial intermediaries in the world. Financial institutions, for example, in the United States context, you have the savings and loans institutions. In several other countries, we have non-banking finance companies. Intermediaries also include insurance companies, mutual funds, pension funds, and so on. And as I said before, their objective is to intermediate funds from savers to borrowers in the most risk-free manner. Now, what is the difference between indirect finance as practiced by the financial intermediaries and direct finance as practiced by the financial market entities? Remember, in the former case, the risk is entirely carried by the financial intermediary. In the case of direct finance, the risk is entirely carried by the saver, i.e. the investor. As an example, if you buy the shares of a company and God forbid that company goes insolvent, you've lost all your money. You have nobody to blame except yourself. On the other hand, if you put your money in a bank and they have lent it to a Mr. X and Mr. X goes insolvent, well, you will still get your money back because it is insured through a deposit guarantee instrument or some form of insurance to make sure that your money will come back to you. Example of financial market entities, money markets. These are very short-term markets where entities can borrow and lend anywhere from overnight, that means one day, to up to 180 days. And then you have foreign exchange markets where currencies are bought and sold. And then you have the debt market where companies issue bonds which are traded in the bond market, or governments issue treasury bonds which again are bought and sold in the T-bond market. And then you have the equity stock market where the equity stocks issued by companies are bought and sold. And then you have the more sophisticated derivatives markets for instruments like currency options, currency futures, commodity futures, and so on and so forth. And then you have the private equity market, which is very recent in origin. In some of our subsequent lessons, we will go through in great detail each of these markets. There are two things that you need to bear in mind. Financial markets operate in two modes: over-the-counter and exchange-traded. Over-the-counter is what you do, for example, when you buy or sell any asset that you have to somebody else. If you've got a motor car and you want to sell it, buyer comes to you and you negotiate the price and you sell the car to him and he pays you the money. You carry all the risk. In other words, if he takes away the car but doesn't pay you the money, you've taken the risk. So in an over-the-counter transaction, the counterparty risk, that means the risk arising from the failure of the other party in the transaction, is completely borne by you. In an exchange-traded transaction, on the other hand, the risk is entirely borne by the exchange, such as the New York Stock Exchange, the Chicago Board of Trade, and so on and so forth. The responsibility of the exchange is to ensure that even if the counterparty fails to meet his obligations, you would still receive the money that is due to you or the service that is due to you. Suppose you have put your money into a bank and then the bank goes and invests that money in the financial market instead of lend to the borrower. If they go and invest it in financial market instruments, and if the money is lost, the bank is in trouble and therefore your funds are in trouble. As a matter of fact, you would all be aware of the 2008 crisis, the genesis of which was the fact that entities, indirect finance, actually went and played excessively in this direct finance, and the ramifications are global. Towards the end of this course, we will understand how it panned out into a global crisis.